when there's too many lenders in the space, it's a race to the bottom. And so if one lender, so let's say we went out to a lender and, they were at 8 million, but the next guy was at 9 million. Then the next guy was at 10 million. The next guy was at 11 million. And then you had a spread of 250. Well, the next guy went to 225. So it's a race to the bottom on everything in terms of the lending environment. So that was not only in terms of terms, but in terms of underwriting. So if somebody came in and they said, well, this guy's got a foreclosure, no problem. This guy's got a bankruptcy, no problem. This guy's never done this before, no problem. Right? Like it wasn't that bad, but basically there's too much money chasing too few deals is what it came down to, except on the lending side. And that was driving the price up.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show on YouTube and distributed on podcasts everywhere. My guest today is James Eng, who is National Director of Old Capital in Texas. He provides lending for multifamily deals, but his focus and primary expertise is on the Texas market, where he has facilitated loans to multifamily deals in excess of $2 billion during 2021 and 2022. What you're going to hear from James today is, I have to tell you, utterly reminiscent of everything that Michael Lewis talked about in The Big Short as relates to residential real estate and how it was financed in the run-up to the global financial crisis, but in multifamily lending in the run-up to the current downturn. James talks about how loans were financed up until the beginning of COVID, what actually triggered a fundamental shift in the way that multifamily loans were financed once COVID kicked in. He also discusses what proportion of the loans that were taken out in the 2 years, 2021 and 2022, are likely to be severely distressed. It is a number that will blow your mind. Basically, it's extraordinary what has been going on and the circular nature of how finance, again, in the same way as Michael Lewis describes in The Big Short, exactly the same way, it seems, for multifamily finance in this last run-up. He also talks about how values and pricing for multifamily properties over this period of time were increased. What drove those increases, what dynamics actually drove those increases, including, although he didn't use this term, what I have to say sounds very much like lax lending standards. And he talks about the kind of underwriting that went into those deals on behalf of sponsors during that period. Also something that you're going to find eye-opening and absolutely fascinating. This podcast today is a must listen to all the way through. James is a font of insight and knowledge about what's been going on with multifamily lending over the last few years. And he also talks about how to identify opportunities when the market turns, as it is beginning to right now, and exactly why the timing is perfect to get involved in that. If you want to learn more about James, go to the podcast page at GowerCrowd.com. And while you're there, be sure to sign up for our newsletter. Subscribe there. There's a big red button somewhere on the page. Go ahead and subscribe. It's totally free. And we cover the world of real estate syndication and crowdfunding, loosely called crowdfunding, every Wednesday, including some commentary and some insights. And also there's always some kind of educational component as well. You can always unsubscribe, all there at GowerCrowd.com. All right. Now, I have to tell you, it just sounds, talking to James, it really does sound, I've said it now twice at least, it does sound like a Big Short redux. If you've read that book, then you will know exactly what I'm talking about. You will hear it in everything that James says. If you've not read it, read it. after you've listened to James's my conversation with James today, you'll see exactly what I mean. Anyway, here we go. Let's turn it over now. James Eng, National Director at Old Capital in Texas. Hey, James, thanks so very much for joining me today in the podcast. Let's just start right at the top. And for context, please tell me what it is that you do and what have you been doing particularly over the last 3 or 4 years. Let's get into recapping what we've just been chatting about.
Sure. So this is James Eng. I'm a mortgage broker based in Dallas, Texas with Full Capital. So we do multifamily loans throughout the nation with a super hyper focus really in Texas. So I'm in Dallas, born and raised in Houston, went to school in Austin. So sort of your major metros in Texas I've lived in and financed a bunch of deals for. Last year we did about 1.2 billion in multifamily loans. So we look at a lot of transactions. Majority of the deals are really B and C, so class B and C properties. Average loan size is right around 10 million. So that is the day job. And then, before I was a mortgage broker, I was a loan underwriter with GE Capital. So from 2005 to 2015, so 10 years at GE Capital, and I was underwriting pretty much everything. So apartments, industrial, retail, self-storage, everything. And I was the guy behind the curtain saying yes or no to your loan. So learned a lot in that space. And now sort of starting in 2015, really focused in on multifamily in terms of the financing side. And then I wanted to invest in a lot of properties. So since then, I've probably done about 40 to 45 multifamily properties since then on the investment side.
Right. So you were telling me about that your shop has financed. I think actually, I'm not sure if I got the numbers exactly right. Was it 1.2 billion last year, 2022?
Yeah, 2022, 1.2 billion.
And then you were also. But tell me the characterization. So pre-COVID, you were looking at agency. Then switched to bridge. Just a recap.
So I started really in the business in 2015. And, majority of the people were doing agency loans. So that was, Fannie, Freddie, fixed rate, 5, 7, 10-year loans. And, it was pretty stable. Like I felt like, rates were around 4.5% to 5.5%. And you just, you could put 75, 80% leverage and you got maybe a year or two interest only. And that's how people bought deals. And if you needed to do a bridge loan, so a shorter term bridge, let's say it didn't qualify for agency, so you couldn't get, it needs to be 90% occupied for the last 90 days. And that's how you get an agency loan. If the property was just broken, mismanaged, then maybe you do a bridge. It was a higher interest rate and it was a shorter term. And so everything was going well. And then boom, COVID hits 2020. All the bridge lenders go away. The only thing you can do is agency. And they made you put up huge reserves. So if your loan was, let's say 10 million, they were like, we'll give you the loan, but we're going to need 5 to 10% set aside. So not only did you get a lower leverage loan, but you had to put up a big reserve. But during COVID, you couldn't go out of the house. And so that was the only lender in town. So that's really what happened. So majority of our volume in 2015 to 2019 was fixed rate agency loans. 2020, more of the same. And in 2021, when basically the Fed took the rates down to zero, people don't really remember that, but 2021 rates came down to zero. 10-year treasury went down basically to 1%. And, you had the option. You had the option of going and getting an agency loan, or you could do a floating rate bridge loan. And this is where the math all changed. And so a lot of people, let's say a deal was, I'm going to try to use easy math here. I know it's hard. I don't know if people are watching on the podcast or video, but let's say a deal was $10 million. Okay. And you said, James, get me a loan from Fannie and Freddie. And I said, all right, yep, we can do a $6 million loan on this deal. So 60% leverage. And you're like, okay, that's pretty good. What does the bridge lender give me on a $10 million purchase? The bridge lender give you $8 million. So they were at 80%. Fannie and Freddie were at 60%.
Okay. It was really that was the difference, 80% versus.
Wait. We're not even.
Gets better.
It gets better.
Okay, go on.
So 10 million was the sort of whisper price. The broker was saying, all right, come tour the property. It's $10 million. Okay. Then, you put in the offer at 10 million. Guess what? There's 20 people at $10 million. So then it goes to the next round, best and final, 11, then 12, then 13. Okay, it's 13 million. Then they say, all right, you've come up to 13 million. The agency loan is still what? $6 million. So now you're under 50% leverage. You're like 45% levered on the deal. The bridge lender, they move up with you. So not only were they doing the 8 million, they're saying, all right, you're at, and let me try to do the math. Let's say you're at 13 million or 14 million. They said, yep, we can do 10 million. Yep, we can do 11 million. Yep, we can do 12. So your equity check was the same, even as your price was going up, right? On the agency side, they were saying, you're at 14 million. The loan that I can give you is 6 million because it's based on in-place cash flow. Every time you went up, you had to raise more equity. And so we just stopped quoting agency.
So the bridge was not looking at DSCR. The bridge was projecting forwards to future.
It was on pro forma. So it was not based on in-place cash flow. It was based on year 3 cash flow projected. And so let's say the bridge lender said, all right, you're paying 14 million now. And now your loan is 10 million, 11 million. And then you said, well, I need $1 million for rehab. Okay, we'll add $1 million on top of that. So now the bridge lender is at $12 million. And so that's what happened in 2021 and 22 on every deal. There was so much money chasing.
That's extraordinary.
That. And now, okay, so when you asked, all right, what was the volume in 21 and 22? What was the mix? 80% of our loans were bridge. And almost 95% of the bridge loans out there were floating rate. And so this was going on across all the major markets. Everything that could be securitized really into what was called CLOs, or collateralized loan obligations. They would do $1 billion worth of these loans, and then they would securitize it. And people would buy it because you could buy a treasury at 1%, or you could buy this loan against a multifamily property, and it was paying you anywhere from 3 to 4% because it was a loan based on SOFR plus, let's say, 3% spread. So SOFR was 0.
In a CLO, right?
Yeah, in a CLO. So you could get 3 or 4% on a loan backed by multifamily, or you could buy the treasury and get 1%. Which one do you want to buy? And so much money. So it was easy to sell that paper. And so it just kept going on and on. So from 2021, January 2021, all the way up until probably summer of 22, that 18 months, it was that bridge lending environment pushed values up significantly.
Who were the bridge lenders, James?
So there was, I would say, at least 25 different ones. So the largest ones are some of the names that, they might have agency shops like an Arbor, or even like, I'm trying to think, like Lument. So a lot of them have agency licenses, but the agency product was based on in-place cash flow, and the leverage was significantly lower. And so a lot of people were on the sidelines. They were just saying, look, I usually use agency loans. I can't get to the $14 million price. I'm at 10 million, and these guys are going to 14, 15, $16 million.
Yes, so I got that. But the bridge lenders, and I want to drill down on a few of these, but the bridge lenders were not banks, right? Who ultimately is holding this paper?
So there's two people holding the paper.
Give me an example.
So let's say
Arbor. About case studies. Give me a case study.
Yeah. Let's say Arbor originates a bridge loan.
Right.
It's usually a 3-year loan plus 2 1-year extensions. And they have a choice. They can hold it on their balance sheet, okay, and manage the loan and etc., and collect that interest, or they can package it and sell it.
Or they can package it to somebody else. Sorry.
Yeah, package.
Or sell it to somebody else that is going to package it.
Well, they typically would package it themselves and
Okay.
then have, let's say, because majority of the loans are in that, let's say 10, 20, $30 million range. And then they would package 30 of those together and then sell them in like a securitization of close to $1 billion. And then people would buy the tranches of that securitization.
Mm-hmm.
So very similar to, 2007, 2008 in the residential space.
Mm-hmm.
And so that's how majority of these deals, they're all being serviced. It might be serviced by Arbor. It might be serviced by KeyBank. It might be serviced all these different special servicers now. And so the investors who invested in those tranches, depending on what tranche you invested in, if those deals start going bad, then they will be taking the losses, not necessarily the people who originated those loans.
And were they tranched? Sorry,
Yeah.
we're kind of going down
You're
a bit of a
getting
rabbit
it.
hole here, but were they tranched in the same way as the tranches were, and
Yep.
then graded by the rating agencies in the same
That's
way?
right. Yep. So
And
it
they
could
don't
go.
tell me that the lower tranches were also packaged and then retranched, please.
Well, I don't know that
Like happened in
particular.
27.
Yeah, I
2000.
don't know if that was it. To me, it was
Like the triple B
$1 billion,
suddenly
and then it
became
was AAA, and then all the way down. But I don't think there was a retranche of the
tranche.
other ones.
Okay.
Yeah.
Okay. All right. So let's kind of come back up the tree. So these are not banks that are providing the bridge debt. These are private equity shops that have institutional capital, presumably ultra high net worth investor capital that are deploying this. Is that right?
Well, so this is what's unique is that a lot of the larger banks were providing lines of credit to. So like, let's say me and you wanted to start a bridge fund.
Mm-hmm.
We would go out and we would raise a little bit of equity, let's say 250 million. But then we would call JP Morgan or Wells Fargo and say, hey, can you give us 750? And now we've got $1 billion to spend our loan out, right?
Okay.
And so we would go loan out that $1 billion and then securitize the paper, and then we do it again.
And then sell that to
we would just keep going. So every quarter we would get a new $1 billion to securitize, and we would lend out the money, securitize it, lend out the money, securitize. So we would just the banks, the bigger banks, they were almost doing like a loan against the loans. So they were even lower leverage than we were. So that's why there were so many. And when there's too many lenders in the space, it's a race to the bottom. And so if one lender, so let's say we went out to a lender and, they were at 8 million, but the next guy was at 9 million. Then the next guy was at 10 million. The next guy was at 11 million. And then you had a spread of 250. Well, the next guy went to 225. So it was a race to the bottom on everything in terms of the lending environment. So that was not only in terms of terms, but in terms of underwriting. So if somebody came in and they said, well, this guy's got a foreclosure, no problem. This guy's got a bankruptcy, no problem. This guy's never done this before, no problem. Right? Like it wasn't that bad, but basically there's too much money chasing too few deals is what it came down to, except on the lending side. And that was driving the price up.
Right. So that all started in 2021, January of 2021.
January 21.
Okay. We are September of 2023. January 24, 3 years later is coming up. Tell me what is going to be happening to all those variable, first of all, floating rate loans,
Sure.
high leverage, high asset value, floating rate loans that went into place that are now actually, they're also climbing in terms of their interest rates as well.
Yeah, the interest rates, sure.
Yeah. They're resetting every month or however often they're resetting.
Yeah, every month they reset. Yep.
So every set. So these borrowers already are struggling because their debt service
did not buy a cap. If they did not buy
okay. So let's go to caps.
Let's
talk about Happy New Year. Yeah.
Okay, so in 2021, everybody was comfortable taking floating rate because the Fed basically said we're not raising rates in 2021. I mean, January 2021, I know I'm in Dallas, but you're in California. I don't think you could go outside your house in California yet in 2021 of January, right?
Correct.
I mean, it was still, I don't think school was in session
Mm-hmm.
right? I mean, a lot of these things were just shut down. So, the Fed's sitting there trying to revitalize the economy, saying, look, guys, we're going to pour a bunch of money on it. We're not raising rates. So in 2021, you could buy a 3-year interest rate cap for pretty much nothing. Let's call it on a $10 million deal. You chip in $20,000 and you could cap SOFR at 1%.
Okay.
And people thought they were throwing money away. They were like, "Oh my goodness, this is a waste of money. I got paid 30,000 for a rate cap."
And SOFR then, just to contextualize, was what we were talking
zero,
about.
like
Zero.
pretty much zero. So they had a range of 0 to 25 basis points. So you could cap it at 1%. But if you looked at a forward curve in 2021 January, it was just flat. It was just on the ground. It was just zero. There was no rate hikes. There was nothing. So when they sold you that rate cap, they basically said, all right, just give me 20,000 and, we'll call it a day just to do the paperwork. And
And what
nobody
would you
thought
have been going? So your loan, that floating rate loan, would have been at what level then?
the leverage
No, not the
or the
leverage.
interest rate.
Yes,
Yeah. So the interest rate would have been SOFR plus 3.
plus
So
three, and so the
3%.
cap said it's not going to go any more than SOFR plus 4. Plus, sorry, yes.
No. So you're capping SOFR. So when you buy that cap,
Oh,
SOFR
capping
would not
SOFR.
be, your spread is always there. So you're
Okay,
capping SOFR. And so you'd have 1% and then plus your spread of 3. So your all in rate for the first 3 years would only be 4%.
maximum 4 if
Maximum.
SOFR
Yeah.
when you went in was 0. Okay,
Yeah. And then if SOFR goes to 5% like it is now,
right.
doesn't matter.
You're still stuck at 1.
Yeah, you base that provider the other guy who took the other side of the trade, every time it is that difference between SOFR and your capped your 1%,
They're
they're going to
writing a
pay you
check.
that difference. They're writing a check.
Yeah.
So they have written a painfully large check every month since they took that 20,000 from you when you bought that cap.
Mm.
And so majority of Fannie Freddie floating rate loans, so you could do an agency floating rate loans, not many were done. Most were done in 2020 when agency was the only guy in town. Most of those guys bought 3-year rate caps. Okay. Most of the guys in 2021 bought 3-year rate caps because it was so cheap. It was like, all right, do I buy a 2-year? Do I buy a 3-year? It doesn't matter. It
But
was
also
20,000.
that lender was mandating it as well.
So the bridge lenders are a little bit like the Wild Wild West. They do not have any regulation in terms of everything's negotiable. Let's just say that. So whatever you negotiate with the lender, some lenders require 3-year rate caps. And then, like I said, it was a race to the bottom. So if this guy required a 3-year rate cap, this guy required a 2-year, this guy required no rate cap, right? So depending on where you were and how aggressive you wanted to be, you didn't even have to buy a rate cap. But in 2022, January, those rate caps started getting more expensive because we started seeing that the forward curve was going to go up. And the Fed was sort of hinting at, hey, we're going to start raising rates in 2022. So those rate caps got more expensive. And so most people went from 3-year caps to 2-year caps. And when they did that, that was great because it was less cost. But now here we are, January 2024, your cap is up. And so you're going to have to do something. SOFR is still at 5. Your spread is still 3%. So your all-in rate is going to go from, let's say 4%, it's going to go to 8. And most properties that were bought on a 4 to 5 cap just can't pay that rate. And so that is going to become why you're going to see, I mean, it's starting now in terms of deals that are coming to market because they've got to sell. And they've got to sell because their loan, let's go back to that original example, their loan is $12 million. They bought the deal for 14, and the property might be worth 10 right now. And so when that happens, you have to do, so Fannie and Freddie are looking at you and saying, guess what? We can still do a $6 million loan if you want it, but your bridge loan is materially higher. So we need a cash in refi to get it all the way back down, to get that leverage back down. And what we haven't really talked about is not only has SOFR gone up, 10-year Treasury has just been on a tear in the last, let's call it 2 or 3 months. And so it's sitting at 4.5 today. So your refinanced rate is closer to 6.5. So even if you don't have if you're trying to get the fixed, your rate right now is about 6.25 to 6.5 on agency.
For fixed. And then what about
Yep.
paying for so that $20,000
Yeah, that rate cap.
1% rate cap
Yeah.
on over SOFR?
Yeah.
Um,
How much is
what
it
is that
now?
going to cost you today?
So right now, it is if you buy a 3-year rate cap, it's close to 9% of the loan amount. So on $10 million, it'd be
And it
$900,000.
was really 20,000
It was
years ago,
20,000 and 21. Yeah.
and now it's nearly $1 million to do
Or
the same
more.
thing.
Yeah. Yeah. So it's just an insane amount of money from where it was. Because basically they were pricing in nothing. That was just more of the transaction cost, just to like do the paperwork.
Right.
But now they basically, to buy that strike, someone has to look at the forward curve and say, look, if it's at 5% and you buy a strike rate at 1%, I've got to pay you that difference every month. Right. So they're just pricing that in
Let's say,
based on the forward
look,
curve.
I don't know, but I mean, I imagine they're also looking at their own P&L and thinking we've got all these losses we need to make up for. So
Oh, sure.
not
Yeah.
not
Yeah.
just the forward
Some of those
risk
guys
that
are
we take.
gone. Some of those banks are gone who provided those caps. But yeah, most of them are. I mean, it's probably okay time to be in it. But what's hard is it's been hard to predict. There's been so much volatility
Right.
that people, until the Fed really starts signaling that they're not going to raise anymore, which they haven't, then the cost of these caps are just extremely high.
Right. So January the 1st, 2024.
Right.
What are we going to start seeing?
We're already seeing it now. So people who have maturities or rate cap expirations, they are selling now. And we've seen deals that are at the loan amount, underneath the loan amount. We're seeing them already. And so majority of these bridge loans, so the space that this is impacting really, I would say, is loans above 5 million or probably more over 10 million. So most of the bridge lenders, they had to do a lot of volume and they had to do it fast. And so they wanted to do $10 million and higher. They wanted to do major markets. They didn't necessarily want to do secondary markets. So most of the stress is going to be in major markets, $10 million and higher. And I only focus in on multifamily, but multifamily seems to be where majority of these loans were done. You know, I'm sure floating rates were done in other spaces like industrial or office and things like that, but I was just not in that space, so I don't want to talk to it.
But 90% of what you did over the billion, actually, but over the last 2 years, so yeah. January 21, so almost 3 years, 1.2 billion last year. In aggregate, how much has your shop done over the last 3 years?
21 and 22, both of them were over a billion. So yeah, we've probably done 3 billion in the last 3 years. Yeah. So, but 2020 was different. 2020 was definitely more agency focused. In 21 and 22, that's where really the bridge lenders turned on in terms of how much they were starting to do.
So can you also characterize, stepping back from this a little bit, characterize the type of borrower, the sponsor? I mean, you've right. kind of jokingly said, you've had foreclosures, you've had bankruptcies, and you've never done this before. Okay, right, basically. Yeah. But in your experience, what has been the characteristics? And I don't want to lead you. I hope you're going to go in the direction I think you might. Okay. But what would be the character? How would you characterize the demographic, if you like, economically of these borrowers in terms of their experience?
I mean, there's definitely some stronger sponsors who have longer track records, but a lot of those guys, I mean, I talked to a guy who's been in it since, the early 90s. And, some people were joking with him and they called him retired. They said, look, you haven't bought anything since 2019. You didn't buy anything in 21. You didn't buy anything in 22. You're retired, man. So, and he was just saying, look, I'm just getting outbid. He was trying to bid on these properties. He was the guy bidding 10 million. Right. And then people ended up being 4 million on top of him. So he was over 40%. So a lot of the guys were newer sponsors. And, some of them, I mean, there's been multiple foreclosures in Houston already from, I would say, a little bit more unsophisticated sponsors where they just put on too much leverage on these deals. And the challenge was, Fannie and Freddie have sort of net worth and liquidity requirements. And I'm not sure if everyone's aware of them, but let's say you do get a $10 million loan, you need to have a $10 million net worth and $1 million liquid if you sign on that loan. And most people on the bridge lending space, they just forgot about that. They did not require that the same way that agency lenders do. And so a lot of the people who got, and people, when you buy a deal in 2019 and you sell in 2021 and cap rates compressed, you made a bunch of money, but you only did a $5 million deal. So you didn't make a ton of money. So then going from the $5 million deal, now in 2021, after you sell it, you're like, all right, let's go to 30 million.
I'm a genius.
I'm a genius. Just do it on a bigger scale. And then you sell it in 2022 for 50 million. Now you're like, all right, let's do a $100 million deal. Right. I mean, this is easy. Right. So people are going along for the ride, and they just had that turn of, 100,000 went to 200, 200 went to 400. Now let's put 400 in 2022 and let's just put it down, and I'm going to sell it in a year and I'm going to make 800,000, like it just kept going. Right. And a lot of syndicators were making money not only on, the promote that they made when selling the deal, but just fees on acquisitions. Right. So a lot of acquisition fees were based on the purchase price. So why not do a bigger deal? It takes the same amount of work. And a lot of these deals, could run better with the management company, et cetera. But the problem is that these deals, when they are upside down and they are large, a lot of these owners just cannot feed them for long. So, if you have a $4 million loan and you can't make the debt service, you can sort of struggle along and figure it out and raise some money and do that. If you have a $40 million loan and it's upside down, it is very hard to feed for that loan.
So so you're an underwriter,
Yep.
by background.
Yeah.
So how were these sponsors justifying? What kind of assumptions were they making in their underwriting to justify a $13 million acquisition with 11 million of debt on a building that the whisper price was 10 million of it? Like what were
it was pro forma NOI. I mean, the NOI essentially would have to go. So usually we would want the NOI. You're buying on a 4 cap. So let's say on the $10 million deal, you bought it on a 4 cap, that NOI was 400,000. And usually you had to pretty much, I'm not going to say double the NOI, but it would probably need a 30 to 40% increase in NOI. So you would have to go from 400 to 600,000 or 700,000. And most of that was on rents. So in 2021, rents were going up 20%. And so people sort of underwrote that, and they could get some of it, right? You could capture some of it. What people didn't underwrite as tightly was taxes and insurance. So taxes in Texas are a big deal.
They reset every year, don't they?
They reset every year, and they can go to the moon. And so you have to fight them every year. And then insurance costs. I just got off a call with a general partner. I mean, it went up 20 to 30% this year. It's going to probably go up another 20 or 30%. So those two costs, especially on the coast, and I don't know how much of a factor this played in those Houston foreclosures, but in Dallas, let's say it's $1,000 per unit for insurance. In Houston, it's double. And almost nobody underwrote 2,000 a door for insurance in Houston.
And that just comes straight off the bottom line. That's what I mean.
Yeah. So you've got higher property taxes, you've got higher insurance, and now you've got rents sort of flattening. And so that is, your NOI might be up 10 to 15%, but then it needed to move 50. And so a lot of those deals were based off of NOI moving 30 to 50%, and it was based on an interest rate of maybe 4.5 to 5, not a 6.5% interest rate that you're going to have to refi out of.
Well, also a lot of the game was projected on exit as well, which was cap rate driven. What's happened to cap rates?
Yeah, so cap rates have moved up. I mean, there's no doubt, when your interest, most people want positive leverage. When rates were around 5%, people were still buying deals at 4.5. They could stomach maybe 50 basis points of negative leverage. But now I mean, now that interest rates are closer to 6.25 to 6.5, your cap rate's still like at a 6. And so most people just are not selling at that number because they would take a loss on the deal. If you're going from a 4 to a 6, that's just too much cap rate expansion for you to sell a deal in 2 years. So
Well,
it's
a
just
four
going to
to
be,
a six is a
yeah.
50%. What is that? It's a 50% loss in value, isn't it? Am I getting that wrong? Or 33%?
It's a big number. I'm not going to try to do
Basically, it
public math.
wipes out
Yeah.
all the equity. I mean, whatever it is, it's like equity is gone.
Right.
And
So
you're
yeah,
banging against debt as being the
yeah,
value of the building.
yes. So I think more deals, let's say if you let's say you had 100% of your equity and now you could sell and get 50% of your equity. I think most sponsors would do it on the floating rate bridge stuff that they have out right now. The challenge is that majority of those people, they might get zero and they just cannot accept a zero right now. And so they're going to have to fight through this. And what we're seeing is, and we've seen some larger sponsors do this, is basically go back to the lender and say, look, you don't want the property. I want to stay in the deal. Let's work a deal. And so they're trying to work out, extensions. I told you the NOI was going to be, $1 million and it's only at 800,000, but I need 2 more years or 3 more years to kick this can down the road. And some lenders are giving it to them, depending on the borrower. And so as long as the borrower can keep paying me, or we're just gonna extend these loans instead of having this maturity, because everyone's thinking that if there's so much distress hitting the market in 2024, that the price that you're gonna get is not gonna be great. So let's just kick the can 2 years and it'll be better. And ideally, it will be better.
What assumptions do you have to make, though, for
The
that to say it's going to be better?
so the main assumption that people are making is two. I would say one is interest rates will be lower.
Okay.
So that's one assumption. Everyone's saying, all right, SOFR is at 525, 550. And the reason it's there is to get inflation down. And as soon as inflation comes down for 6 to 9 months, they'll bring it back down. And everything will be great with the world again.
How far do you have to assume it's going to come down?
I mean, most people are thinking it's going to come down from 5.5 down to, let's say, 4.5 next year and then 3.5 the year after that. So let's say in 2025, 2026, you're at 3.5. That's not bad, right? And then your 10-year treasuries hovering around 3.5 to 4. And then the thought also is the amount of multifamily supply, the new stuff, the new construction stuff that's coming online this year and next year is large. And the amount of new stuff coming on in 25 and 26 is going to be a lot lower. So that's another thought is maybe if you're in the A space, you're going to get more rent growth in those years, those outer years, because nobody's starting new development right now. It's the debt's too expensive and the equity's too hard. So no new developments are starting right now. And so that combination of factors that's why people are thinking, all right, I kick the can 2 years and then I'll be in pretty good shape in 25 and 26.
And banks, so these are not the ones that made these bridge loans they're not your high street banks. These are
no. So
can you characterize them as private equity? Is that how you describe them?
The best is probably just like it's debt funds. So debt funds. So they would raise money similar to a private equity shop, but they were raising money for debt.
For debt.
Yeah, for debt.
Okay. So are they amenable to loan extensions? Like what's their
so I would say,
like you mentioned Arbor. Arbor
yeah.
was willing to foreclose and sell.
Well, I'm thinking the reason that they foreclosed is the guy stopped paying. So
yes.
If the borrower stops paying, then they have really no choice. Yeah,
right.
They got to take it back. But if it's a larger borrower, they're willing to keep paying this deal. I think it's going to be dependent on where it sits. If it sits on the balance sheet of the lender. So when I was at GE, all of our loans, we did not see, we had a CMBS, our commercial mortgage-backed security, product, and we had a balance sheet product. And that balance sheet product was our discretion on what to do with those deals. We could foreclose, we could extend them, we could work them out. And I think this is what's going to happen if it's sitting on the balance sheet of a lot of these lenders is they're going to say, all right, look, we're going to give you another year. We're going to keep your interest rate the same, but you're going to pay us not just the interest. We're going to get some sort of kicker that if you do sell this deal, you're going to pay not only the loan balance, but you're going to pay us a percentage above that.
Okay.
And so that's what I saw back in the day of what we did for some of these borrowers, because really the borrower can't go to another lender.
Like a percentage of the sale price, James, or something?
Yeah.
Like
So it's you could call it like an equity kicker.
right.
So it's like, all right, yep, you pay me the loan back. Great. You pay me the interest back. Great. But you made $1 million. I want half of that.
So it's almost like conversion to a mezz debt.
Yeah. No, it's more like you're getting a piece of the equity. I mean, a mezz loan is typically just like a higher percentage. So your first mortgage, let's say it's 5 or 6%. A mezz loan might be 10 to 15%, right? But it's a set interest rate. But this is almost like saying, all right, now my debt is becoming, it's almost like convertible equity to some extent.
Convertible equity, okay.
Yeah, now you're saying, look, if we're going to go on this ride for 3 more years, I thought I was getting paid back in 2024. I'm not. I'm getting paid back in 2027. It has to be worth my while to go on this ride. And to go on the ride, we're going to defer some of your payments, but also we're going to take any equity gain that you have, a percentage of that. It might not be 50%, right? It might be 10% or 15%, but you're getting incentivized for the lender to do that deal.
And are you seeing that kind of structure?
So right now, not enough distress has hit and not enough maturities have hit yet. Except for, so in 2021, some people did 2-year bridge loans, and those are coming up right now. And a lot of them, they cannot refi and they cannot sell. So we're going to find out real quick.
They can't sell. Why? Because the value is less than what they owe.
Yes. The value is less than the debt. And so they would imagine this, the seller's bringing money to the table to close out the deal, to avoid foreclosure.
Oh
so
right.
Yeah, because let's say the loan, like,
to avoid foreclosure.
Yeah, because I mean, okay, so let's say there was a deal here in Fort Worth in Dallas. The loan was $36 million, and they were selling for 35. So the seller had to bring $1 million to close this deal out just to pay the loan off.
Why would they want to do that and not just allow for a foreclosure? I have some answers of my own, but why?
Well, I mean, if you get foreclosed on, I mean, essentially your career as a syndicator is done for a while. I mean, you might resurrect 4 or 5 years from now, or you might be on the sidelines, for a couple years. You might be doing something else for a couple years. And you will forever have to put that on every loan application for the rest of your life. And so I think some people are willing to take a loss, and just move on and just say, look, we should have hedged. We should have taken lower leverage. We learned our lesson. And honestly, I mean, to me, if I'm an LP in a deal, and if a GP says, look, these are all the reasons why we lost money on this deal, and on this deal, we're doing it completely different. This is the basis. This is the loan product. And you articulate that, and this is the lesson learned. I mean, I think I'm still okay investing with that general partner. But you've just got to be upfront about it. And, they might not have access to the best lending products for a couple years until they sort of get their track record back.
Okay, so let's move to wrapping up. Goodness me, we've been talking a long time. I just noticed that. Thank you so much, James. We actually started a long time ago. We just started recording. So actually, let me just wrap up with a final question for the podcast, but we should definitely talk more. All right. So for investors, and I would be clear with what I mean by that. Investors being both, well-positioned sponsors, GPs, but also for limited partners, right? Where are the opportunities going to be, and how are they going to be found?
Sure. Yeah, I mean, right now, whenever a deal comes out, so listing brokers, let's say in Dallas, they basically all have an email list, and when a deal comes out, they blast it out to their email list, and people will do tours, etc. Every time that happens, I'm looking up what type of loan the seller has and what's the motivation of the seller. And if the seller has maturity in the next 12 months, they're motivated. If they don't have a maturity until 2028, they ain't that motivated, right? And so number one, you've got to find a motivated seller, because at that point, those people. So in 21 and 22, people were motivated because they were getting the highest price that they had ever seen in their life. So they were motivated. Every sale went through. Right now, what we're seeing is deals are getting listed. Let's say they want 50 million. Bids are coming in at 45. And the deal doesn't trade. Seller's like, forget it. I'm just going to wait. I'm waiting for a couple more years. So number one, you have to find a motivated seller that's going no matter what, because then you're going to actually get a deal. Number two, you've got to figure out what loan structure that property can qualify for. So we've seen some deals that are completely broken, because what happens is the lender has to be paid, but the repairs and maintenance, the maintenance guy, the new toilets, those don't necessarily have to be paid. And so what we see is people are paying the interest on some of these loans, but then they're not paying the maintenance guy. They're not doing the rehab. They're not doing the maintenance on the property. And the spiral of that, I'm going to take from this unit, put it in this unit, and all of a sudden you got 15 down units that you can't lease. That's a problem, because not only there's no income, but then also you can't qualify for an agency loan.
And you've got deferred maintenance that still
so you've got to build that in. So motivated seller, figure out what type of loan, and if you do have to take a bridge loan, you've got to be compensated for that risk, right? So a lot of people were doing bridge loans in 21 and 22, but they weren't being compensated to take on that risk. Okay. And the third thing I would say is this cap rate expansion. You've got to underwrite a residual cap rate that is at least 50 to 75 basis points higher than where you are today. And most of the cap rates that we're seeing are probably, let's say on an A deal, 525 to 575. On a B deal, it's going probably north of 6. And then for a C deal, it might be 7 to 8. And so what I didn't talk about before in 21 and 22 time is that you were not getting compensated for the risk of going from A to B to C. So cap rates compressed all the way down to 4 on everything, A, B, and C. And now we're seeing those cap rates come all the way back out. And this was happening in primary markets and secondary markets. Yeah. And so now the primary Class A deal, like this picture, if you can see the video, this is a primary Class A deal. This is only expanding maybe 100 basis points. Okay. So it's going from 4 to 5, 525. But a B deal is going 200 basis points.
Well, hang on a second. Just let me jump in there. How can it be only 525 cap rate on a deal where debt is 6? I mean, that's still.
Oh, no. So the market is slower. Mm-hmm. So when the rates were 5.5 to 575, that's where most deals were pricing, that 525. Just in the last 2 months, where it's run another 40 basis points, there hasn't been any transactions yet. So we haven't seen, but you're right. Most people can only stomach that 50 basis points of negative leverage. And so, yeah, if it sits up here, and so this is what's killing a lot of deals right now, is now a buyer who's bidding on a deal is saying, look, I'm getting a quote from James and it's 625, 650 on the interest rate. So I'm going to peg this at a 6 cap. Mm-hmm. And here's my bid. And it's 10 to 15% below what the seller thought they were getting 2 months ago. Mm-hmm. And they were already down 20% from the peak. Right. So now it's added to that.
And are your bridge lenders still in the market?
There are bridge lenders in the market.
For that buyer.
And they are okay. The bridge lenders are okay because they're looking at this as, okay, well, the price has been reset. Mm-hmm. They're requirements are stricter because instead of there being 20 lenders, there's 3. And so they can be more particular on who they give these loans to. And most of the time, they're requiring a 3-year rate cap, and they are buying it very tight. So they're buying like a 2% strike rate. So they're capping SOFR for at 2%, and their spread is about 3.5. So the all-in rate's 5.5 for 3 years, right? And everyone's thinking rates are going to come down, and it'll be fine. So that piece of it, people are okay with bridge loans, but what you have to convey, so the general partner might be okay with it, the lender might be okay with it. Now you've got to go raise the equity. And so if you go out to LPs and you say, I'm doing a bridge loan, that might just be like, all right, I'm out, I'm done. Shut the webinar off, I'm done, right? So because they have enough deals where that's the problem. So they're not necessarily going to sign up for a new deal with the same structure.
Yeah.
Right. So to me, you want to find a motivated seller. You want to find a good debt structure that you're comfortable with. And then you're basically getting a reset basis. Unfortunately, the debt is going to be high right now. But a lot of people are just buying on the basis that, let's say on a Class B deal in Dallas, it was going from anywhere from 150 to 200 a door in Dallas, Class B, 1980s. And now it's been reset. It's going to be 100 to 150. So you're getting that 25, 30% discount. That's a little bit expensive right now, but that's why I think people feel comfortable stepping back into the market.
And are people investing now for yield over the next few years primarily, or are they still looking for equity multiple?
So you cannot give yield. That's the problem. Is if you buy on a 5.5 to 6 cap and your interest rate is 6, your cash on cash is going to be 3 or very low, and that's on IO, right? And so most people are not going to be. You're not going to beat a 2-year treasury right now on cash on cash.
Isn't that crazy?
Yeah. So you're going to have to make it up, right? So your basis has to be better, and then your cash on cash by year 2, year 3 has to be better than what you got. And so that's the competition, right? The same way that it was so easy to raise money in 21 and 22 was people were saying, all right, how much am I getting in my bank account? 0. So my cash on cash is 4, sign me up. Money was going into the deal, right? Because the alternative was 0 for your money.
Well, and today you can get 5%.
You get 5 now. Yep.
With 0 risk at the bank.
Right. That's right.
James Eng, Old Capital, as young as you are. Thank you so much for joining me.
Of course. Thanks for having me. Anybody. So I would say I'll do a couple plugs if that's okay.
Please. Yeah. I usually do that anyway.
Yeah. So a couple, so we do a podcast, oldcapitalpodcast.com. So you can go there. We do a conference once a year. So that's actually next week. So you might be late in hearing that, but we do a conference here in Dallas for 400 or 500 of our closest multifamily friends. That's next week. And then I'm trying to think what else. And then obviously, if you have any questions about financing or looking at deals, happy to look at. So people usually reach out to us for debt quotes, but then usually we give them a debt quote, but we usually give our 2 cents as well, just in terms of what the seller has, how they financed it in the past. We usually know majority of the players in Texas. And so we can give you a little feedback on the area, submarket, and the seller as well.
You're strictly Texas, right?
So we lend nationwide, but majority, I would say 75 to 80% of what we do is in Texas. And so I grew up in sort of all these markets. And so that's where I invest. So my knowledge is definitely a lot tighter in these markets here.
And website, what's your website for us, James?
Just oldcapitallending.com. And then if you just Google my name, you'll find like YouTube videos and LinkedIn and all that stuff, and email. So,
yeah, and I'll include links on the show notes page as well. So anyway, really, James, thanks so much for joining me today.
All right, thanks a lot, Adam.
All right, that was James Eng, National Director at Old Capital in Texas, a lender primarily to multifamily real estate sponsors in Texas, but also nationwide. As you can see, the dynamics of the way that the market has been structured, or finance has been structured over the last few years, really has teed up the inevitability of a crash in multifamily real estate values, and inevitably a transfer of assets from those who invested perhaps imprudently over the last few years to those who are cash rich today and who are looking for price resetting as the market pivots now to a new higher interest rate environment. If you want to know more about James, like I said earlier, go to the podcast page at gowercrowd.com. And while you're there, and I'll include some links, a link to his website, to his LinkedIn profile, and some other links over there. So you can learn more about James and make contact with him, of course. And while you're there, of course, if you've not already subscribed to our newsletter, please go ahead and do that. There's a button on the page there somewhere. It says subscribe. It's totally free. It goes out every Wednesday, and we provide the latest updates on what's going on in the industry, in the real estate, syndication, and crowdfunding industry. It's totally free. You can always unsubscribe, right? So nothing to lose. Go ahead and subscribe there at gowercrowd.com. All right, that's it for this week. I will see you on the next episode. And for now, James, thank you so much for having joined me today. It was a real pleasure to meet you. And thank you also, dear viewers, for joining us. I hope you found today's conversation as insightful as I did, and I would be interested to hear if you agree or don't agree with me that it is reminiscent of exactly what happened to residential lending during the run-up to the global financial crisis, what is or has been happening to multifamily finance over the last few years. That's it for this episode. Thanks so much, everybody, for having joined me today. And for now, this is Adam Gower signing off.